Hayk Kalantaryan, a student at the Global Forecasting School and an employee at the Central Bank of Armenia. I was recently in Portugal for the month-long bootcamp where we drafted the recent version of the Not the Fed Till book, and we start off with the presentation today. Under EPAS Mark II, our emphasis is on advancing beyond more machine-driven predictions. Rather than solely developing predictive tools, we prioritize a deeper engagement with advanced economic concepts. Today's discussions delve into nuanced topics such as precautionary savings and endogenous money creation, building on insights shared by Chris Carroll a few years ago at the CBA. And this slide serves as an indicator of the focal points in our analysis. We find relevance in exploring consumption and saving, particularly in the context of discussing the saving rate and its implications in case A and case B scenarios. Additionally, we consider the dynamics of endogenous money creation or a distraction, especially as we navigate potential recessionary scenarios. First of all, we have Atlanta Fed providing us weekly nowcasting for the US GDP growth. And they are currently monitoring with few indicators in hand, as we can see. Initially, the fourth quarter GDP was estimated at 1.2%. However, subsequent data on manufacturing and auto sales, as well as international trade, resulted in an upward revision of GDP now 2.1%. If GDP was aligned with the GDP nowcast, the 2% growth would be above the estimates of 1.7 to 1.8% potential growth rate, and we would observe a case A type of scenario. And the labor market, still being at historical lows, brings the prospects of further intensification. And the question is, where do we stand in terms of our preferred methodology? And what do we think of such estimates for GDP now? While we refrain from claiming it as the definitive GDP estimate, we will say it serves as our best estimate based on the available data. Also, if you look inside the GDP now, you have a consumption growth rate of around 2.6%. So this would be another quarter where consumers will be consuming out of their wealth, allowing consumption to rise by more than GDP growth. And this will be consistent with the saving rate declining a little bit. This was our case. However, the intrigue deepens when we examine the employment numbers from last October, which came out recently. Overall, the October 2023 jobs report was a mixed bag, I would say. On the one hand, non-farm payrolls increased by 150,000, which is a 0.1% increase. But overall, market experienced a decline as unemployment levels reached 3.9% from 3.8% in September. Then you might wonder why the market would fall if we had the 0% increase in the payrolls. What caused the market to fall was the decline in employment from the household survey, which is used to compute the unemployment rate. It's essential to note the dual nature of these surveys. Payroll data is sourced from surveying firms, and household population surveys are coming from household survey data. If we potentially continue to observe certain degree of cooling in the labor market and track the blue chip consensus estimates that are around 1% growth, we will observe a case B type of considerations are being in play. And with these case B scenarios, the blue chip forecast of 1% will suggest that we are entering a growth recession. A growth recession is when the GDP records positive growth, which is below the potential growth, 1.7 to 1.8%. So this will be the beginning of a growth recession and not a classical recession, where there's actually contraction in the output. In a nutshell, in case a scenario aligned with GDP now estimates, the GDP growth is exceeding the 1.7 to 1.8% potential growth. In case B scenario, a cooling labor market, along with blue chip consensus estimates of around 1% growth, suggests the beginning of a growth recession. I would like to emphasize how nice Mark II has been performing over the last year, especially for thinking about interest rate paths. One of the proofs have been the Not the Fed Till book that we have been publishing for a year. And since we have been doing these case A and case B scenarios, the market rates have been just bouncing back and forth. What happened in the financial market was that in September, we had worrisome inflation number, and that's why we got the markets to start thinking about higher for longer rates and increasing their expectations of future interest rate path. On the other hand, rather promising news, let's say, on labor market potentially cooling down, as already discussed, have led to market participants expecting slightly lower interest rates, and the interest rate path shifted down compared to September. When the September inflation numbers were out, they were higher than the target. And if you look at our trademark of underlying inflation, which would be the sticky price inflation by Atlanta Fed, it remains persistently high. And markets are anticipating higher for longer policies. When people were just looking at the year-over-year numbers and assuming that the fight against inflation might be over and declaring a victory, let's say, they were just extrapolating. First of all, it's too early to call this a soft landing. Excessive confidence in a soft landing scenario is what we would call this. Secondly, often discussions revolve around the consumer price index, and people just extrapolate. But it's crucial to break away from conventional thinking and consider a broader perspective. That's why we heavily invest in analyzing the patterns of sticky prices. Let me guide you through our approach. Instead of fixating solely on the CPI, we aim to encourage a more comprehensive understanding. And the problem is that some might focus on the headline CPI figures. And if we all just looked at the 12-month headline numbers, we might get the wrong impression by thinking that it is getting some progression. But knowing that this year-over-year measure is a moving average of the 3 months over 3 months, we can as well monitor the 3 month over 3 month annualized sticky prices and observe that there appears to be an inflation premium, surpassing the commonly acknowledged 3% and resting closer to 4.5%. And this isn't merely an extrapolation. It's a nuanced interpretation of the evolving economic landscape. So the question is, where will this 4.4% go in the future? We think that it's quite likely that inflation expectations will kind of lock in at that number, indicating a case scenario, unless there is significant slack that's created in the labor market and the product market to basically cool inflation down. Meanwhile, this doesn't mean that we're ignoring flexible prices. By constructing this measure of non-traded sticky price inflation, what we are doing is separating the CPI into flexible and non-traded sticky prices so we can talk about the monetary transmission mechanism. The first thing is that because the exchange rate is so fundamental in this monetary transmission mechanism, and that exchange rate depends on expected interest rate differentials, and therefore the expected path of the policy rate in the US, and that's what determines the exchange rate through the risk-adjusted UIP. And because of that, we have to separate between measures of flexible and sticky prices. we can still focus on things that were first due to generalized excess demand or supply condition. But the thing is that if not addressed, underlying measures of inflation, like the non-traded sticky prices, might raise and signal changes in the underlying fundamentals. Now, rather than looking at bad measures of CPI and bad measures of core inflation and so on, we also don't want to look at measures of employment costs, such as employment cost index or quarterly earnings, because we know that those kind of measures might have measurement errors. So instead, and again, thanks to Atlanta Fed Wage Growth Tracker, we have a measure of median wages. Unfortunately, this thing is noisy. So they take 3-month moving average of a year-on-year measures for the wage growth. But when we look at that, because we are comparing year-on-years, and it's a 3-month moving average of this year-on-year measure, it lends into this idea that this wage growth is just another sticky price measure in the economy. And of course, it happens that there's a very high correlation between this measure of sticky wages and these sticky prices. And the point I would emphasize here is that in the latest October release, the wage growth number was 5.2%, exactly what it was in September. And the question is not just looking at whether it has been declining, but what if it were to stabilize at 5.2%? Well, with 1% productivity growth, this wage indicator would suggest underlying inflation might be around 4%. And that's a little worrisome, we would say, because now we have sticky price inflation at 4.4%, indicating a case A consideration. So now we are not talking about 3 to 4% range anymore, as highlighted in the graph. We are talking about 4 to 5% range. And if we were to get a 4 to 5% indicator before the next FOMC meeting on December 12th to 13th, and the CPI measures coming out on the 12th of December, it would be quite intriguing to follow. Now, despite the aforementioned discussions giving us hints for case-like considerations and having this excessive confidence in soft landing, the question is, will we have instead recession? And if so, when do we get it? At this point, we have many of the conditions satisfied, in the sense that if you look at all the recessions in the post-war era, most of them were monetary boom-bust cycles where inflation was allowed to get high, and then the Fed eventually raised interest rates. And this was usually at a time where unemployment was very low. So all three of those things seems that we kind of have. That would say that inflation is too high now, unemployment is too low, and the labor market is overheating, and yes, we did raise interest rates. So what variables do we look at to understand that from perspective of endogenous money creation? We look at bank lending tightening measures. And when you look at that survey, we got 3 reads of around plus 40 in the previous quarters. And the latest read also suggests that there's significant tightening. And based on past behavior, bank lending tightening would suggest that now a recession is likely to start, given that this thing has been plus 40 for 3 consecutive quarters, and that there's approximately a 12 to 15-month lead time when this starts to predict something really big, like recession coming in the 4th quarter. And this suggests that this would be consistent with a growth recession starting in the 4th quarter. So we would witness case B aligned with a blue chip kind of 1% growth, and then a contraction starting in quarter 1 and quarter 2. Now, what happens then? Well, the recessionary dynamics takes hold. The psychology, equity prices look correct, consumer confidence would decline, banks would continue to tighten credit conditions, maybe at a lower rate than this, but that would still be consistent if asset prices and consumption were to fall. And of course, we go into the environment where firms are not going to invest aside from perhaps artificial intelligence technologies. And given the state of commercial real estate sector in the US, this could create pretty significant domino effects, more fragility in the banking sector. So we notice that case B scenarios are in play, but they're a little bit more difficult to predict than case A scenarios. Lastly, let me give you a little tour through what we think are the principal causes of the saving rate now. Of course, saving and consumption are two sides of the same coin. So any explanation for consumption must align with that of the saving rate. We have a couple of charts here. One is the standard saving rate that's produced from the national accounts, and these are monthly data. And one can see a gigantic increase during COVID. Part of these real spikes are related to the transfer payments when the government checks went out to the households. Now, what we are interested in is the pattern of recent saving rates being significantly lower than the pre-COVID period levels. In the pre-COVID, it was just above 7%, as illustrated by the lines on the graph. And we have also drawn a 5% line here to show that the saving rate was only below the 5% line before the global financial crisis. We have multiple views about how quickly the saving rate might return towards the pre-COVID level. To understand that, we have to understand what drove the saving rate. And we have three factors that we would like to emphasize. Firstly, there was an increase in precautionary saving due to massive uncertainty early in COVID days. People thought the sky was falling and uncertainty went up, leading to a big increase in the saving rate. And as those issues were resolved, like with the vaccines coming, uncertainty gradually declined. And we have got clear indicators of this by looking at the standard measures of unemployment uncertainty, such as the Google searches on unemployment, which were at their historical peak in the early 2020. Of course, income and health uncertainty were the other factors affecting precautionary saving. Secondly, the consumer basket was restricted, as certain activities like international air travel became impossible. Consumers could not consume all the items they would like to consume, and people just put those funds aside for further spending. So they would engage in revenge spending mode. One of the key indicators we closely observe is in the aviation sector, particularly flight bookings. That's why we think the saving rate will be below for some period of time, as households need to deplete these funds gradually. Additionally, during COVID, there was a shift towards home production, leading to increased investment in residential construction and an increase in desired stock of durables like automobiles and home office equipment. Therefore, from such perspective, the sustainability of the current spending surge might be relatively short-lived. To gain clarity on potential scenarios, we turn examining the dynamics of assets, liabilities, and the net wealth of households, so the household balance sheet. Looking at historical figures, notably before the global financial crisis, it reveals a low private saving rate, indicating a tendency to underestimate risk. This led to excessive credit expansion, asset price bubble, and the subsequent crisis. Drawing parallels, if consumption outpaces income, similar consequences could unfold, posing a threat of accumulating household liabilities and a potential financial crisis in the coming year. And the regulatory forbearance during pandemic has contributed to the expansion of an asset price bubble, as seen in the surge in financial and property value. So the left-hand side is rather a Keynesian national accounts view, and the right-hand side is a notion of saving as the change in wealth, which require a comprehensive understanding of this concept. Therefore, the two hypothetical scenarios, namely case A and case B, would illustrate potential trajectories of the saving rate in response to varying economic conditions and policy actions. On the one hand, case A would represent a scenario where the saving rate remains low initially, followed by an increase due to raising interest rates and economic uncertainty. Additionally, sustainability of the current spending surge, particularly related to the revenge spending, may be relatively short-lived as people build up stock of durables and are taking their long-awaited vacations. On the other hand, case B will suggest a more gradual increase in the saving rate, accumulation of liabilities, coinciding with a growth recession, a decline in equity prices, and a raise in precautionary savings. And lastly, emphasizing the need for a more comprehensive understanding of macroeconomic drivers, it is essential to move beyond simplistic economic notions as signified by the shift from elevator economics to more sophisticated framework in our discussion. This was it for today. Thank you for your time.